Most dividend stocks and dividend ETFs pay their dividend quarterly or every 3 months. But our financial lives are monthly. All our bills are monthly. Wouldn't it be great if our dividends were monthly? Today we're going to look at one monthly paying dividend ETF. Without any further ado, let's jump into my computer. The Global X Super Dividend ETF website, ticker symbol sDIV. We're going to review this monthly dividend ETF. There's tons of monthly dividend ETF, and we'll go through them at a different time. But today, let's focus on one. So, what are the reasons to consider sDIV? Well, right here it says high income potential. So if you're thinking about, well, I would like to get paid monthly because my bills and my financial life are monthly, one of the reasons to consider. It gives you access to 100 of the highest dividend paying equities around the world, and that's key. Not just the US, but also internationally to potentially get a higher yield. Another reason you may want to consider monthly distributions. Most other stocks and ETF are going to pay you every quarter or every 3 months. In the case of sDIV, you get monthly distributions, which is great. The inception date that the ETF was opened was June 8th, 2011. So it's been 12 years plus running, and it's been making monthly distribution over that entire time. Global exposure. So that's excellent, right? That's awesome. Now, we see the number of holdings, about 109. We see the underlying index that it followed is the Solo Active Global Super Dividend Index. We'll go through that in a minute. There are $733 million in assets under management. Okay? Which is less than a billion. That's a relatively small asset under management, right? Because we have other ETFs out there with 5, 10, 20, 40 billion dollars on the management. So it is less than $1 billion, so it's relatively small. The net expense ratio is 0.58, which basically means for every $10,000, you'd move the decimal places 4 places to the right. So it'd be 1, 2, it'll be 58 cents, $5.80, $58. So $58 would be the expense to you for every $10,000 on the management, or $5.80 for every $1,000. So we say expense ratio over 0.5 is a little high, right? You're gonna get about 11%, about 11 or 12, between 11 and 12% yield, which is pretty good. So it's a very high yield. Okay, let us look at the inclusion criteria. Okay, so sDIV, Super Dividend ETF, the fund objective. The Global X Super Dividend ETF seeks investment results that correspond generally to the price and yield performance before fees and expenses of the solo active Global Super Dividend Index. That is the index that they track. Okay, so sDIV. Let's look at the selection pool. That's what you want to look at. How do they choose the companies to include in this ETF? Okay, selection pool. The stocks have to be listed on a regulated stock exchange in the form of shares tradable for foreign investors without restriction. Another criteria. So it has to be stocks that's traded on an exchange in the corresponding country. The dividend yield has to be greater than 6% and less than 20% on the selection day. So the day that the managers are choosing the company, the yield has to be greater than 6% and less than 20% on the selection day for companies which currently are not index components. So if they are not index components, the criteria is dividend yield greater than 6 and less than 20. If they are part of the index, the dividend yield only has to be greater than 3% for companies which currently are index components. Okay, the market cap has to be at least $500 million on the selection day. Okay, and the average daily volume in the last 3 months of at least $1 million on the respective selection day, meaning $1 million of stocks have to be traded on the average over the last 3 months. The dividend forecast has to be stable. So there can't be any announcements or anything in the news saying that there's going to be an impending dividend cut. The dividend forecast has to be stable. Okay? There's not going to be any closed end fund, no partnership. And basically, a closed end fund is basically a fund that collects, a fund that gets investments to begin the fund, but then takes no more investments after the fund is open. No BDC or business development companies. These are companies that basically lend money, give loans to certain companies in the middle market. They're not super small, but they're not super big. But there's no BDCs in this ETF. Okay? So those are the criteria. Okay. All components are equally weighted. Okay? So all of the 109 companies have a pretty much equal weighting, ranking. To determine the initial composition, the companies in the selection pool are ranked in descending order according to their dividend yield. So with the higher yield first, so you have a yield of 18%, you'll be linking higher. You have a yield of only 6%, you'll be lower. Okay? Okay, so let's move down to rebalancing. It looks like the ETF is balanced in February. It looks like the ETF is balanced on the last business day in February over a 5-day period. And they have some quarterly reviews in May, August, and November. Okay, so that's the selection criteria, right? They got to be high dividend, right? They're somewhere between over 6 to less than 20%. So that's a very high yield. The dividend has to be considered stable. Okay. Now let's look at the country breakdown. About a third of the stocks in this ETF is from the United States, 34%. And then you have Australia, 10%, Brazil, 10%, Hong Kong. You see all these other countries. That's why you get the international diversification. And look at the industry breakdown, right? We see here mortgage REITs, 20%, which is a large portion. You have REITs, which is real estate investment trust, almost like another 10%. So combine that, it's like 30% has to do with real estate. Energy, 18%. Materials, 16%. Financial, 11%. Industrial, 7%. And everything else in the low to mid single digits. Communication, consumer discretionary, utilities. So you have to be comfortable with this. Let's look at the performance. Now, year to date, the ETF is down about 1.33%. Over the last year, the ETF is up about 9%. Over the last 3 years, it's down about 2.5%. Last 5 years, down about 10%. Last 10 years, about down. Over the last 10 years, down 3%. And since the inception in 2011, it's down almost 2%. So in terms of capital appreciation, you have lost money, right? You gotta remember that. These are all, a lot of them international companies. Now let's look into the actual holdings. Okay, so we already know that real estate is a large portion, right? Basic materials, energy, industrial, very large portion. Now, top 10 holdings. A lot of these companies are companies that we're not going to recognize. Ready Capital Corporation, 2%. But then again, this is a very international dominated ETF. BW, never heard of that. Orient Overseas International Limited, never heard of it, 1.6%. CSN, again, never heard of that, 1.5%. And you just go down the name, go down the list, top 10, probably a Chinese company. And you see most of the companies, you're not going to know them. The holdings as of November 13th, 2023, the holding as of November 13th, 2023, is 115 holdings. Even the way they write the dates, right? They put the year first, then the month, and then the date, right? In the US, we do it month, day, and then date. So, and international flavor. So, most of them you're not going to recognize. Let's look at the summary. So, right now it's trading at about $21 a share. The 52-week range is between $20 and about 26. So right now it's closer to the low end of the 52-week range. The expense ratio with it is 0.58, right? So about $58 for every 10,000 invested. The dividend frequency is monthly, which we know we like that. The dividend rate, this is the trailing 12 months. They're paying $2.74 annually. The yield, very nice yield, almost 13%, 12.69%. But keep in mind that the actual underlying asset is actually has lost value. It's lost value over time. It's lost value. $736 million in assets under management. So, this is something I got to consider. If you look at the chart here, let's look at the max chart here. It looked like here, it opened and it was like here, trading about $75. And now it's trading at $22, right? It's lost a lot of value, even while paying out dividends. So that's something you want to consider, right? You want your underlying assets to go up in value. Let's look at our dividends. Let's look at our dividend history. Okay, so we see dividend yield is 12.69%, but the dividend growth rate is negative. There's no dividend growth rate, right? So they must be cutting their dividends because it's a negative growth rate. So let's look at the dividend history and let's see exactly, because we're investing in these ETF because we want to get increasing dividends. Over the last, let's do 10 years. Let's do max. So 2011. There we look like here 30 cents, and they fluctuate in July. It was 24 cents. So it kind of fluctuates, right? Yeah, you see it kind of fluctuate. You see here in 2012, 47 cents, right? You see a couple of high marks here, 2012, 91 cents. But for the most part, it's been pretty consistent. And there's a little dip here in 2019, down to 31 cents. And these are all monthly, right? 24 cents, been steady. It popped up here a little, but for the most part, it's consistent. Now it looks like it's about 20. In November 2nd, 2023, they paid 21 cents dividend. So the dividend is not growing. That is concerning. The dividend is not growing. Okay, it's hot, but the yield is high. You're getting a high current yield, but there's really no dividend growth to speak of, and the asset is losing value. Okay, so that is concerning. Let's see here. What else we could look at here? So there is no dividend growth. All right. Yeah, there is no dividend growth. Yeah, you can see it here over the 10-year. This is the annual dividend. 485. You see, pretty much flat, a little flat, and then 2020 went down, right, because of the pandemic. But there's not much dividend growth. But you're getting a high current yield. You're getting almost like a 12, 13% yield. So this is something that pros and cons. So the pros of sDIV are monthly payment, which is great. It's also great that you're getting a high current dividend yield. We're talking about 12% or 13%. You're diversified, so it's not just U.S. You get diversified around the globe, which is great. But the downside is the value of your online investment is losing value, and there is no dividend growth. Um, but it's something to consider, right? Because if most of your other investments are paying quarterly, it may be nice to have something monthly. But again, you know, that's why you have to do your due diligence, right? Not giving you financial advice, but giving you something to consider. Again, this is the MD investor that's trying to give it. Again, this is the MD investor that's trying to increase our financial IQ so we can teach our children and break the cycle of generational poverty. MD investor out.